So thanks for joining us, Spellman Board. My name is Jesse Donlinger. Today we'll be joining me with Hunter, Ryan, and Connor. The company that we are pitching to you guys is Pfizer. Yesterday at 3 o'clock, the Pfizer closed at $41.73. Between the after hours, there was an FDA approval for a vaccine, and they shot up to 42.81 in the morning. The current PE is $26.69. The target price is just under $44. The target return is 6.5%, and our recommendation is buy. In this presentation, we're going to go over the company's background, the industry overview, the industry competitors, the company's financials, the growth opportunities and key drivers we think are important, the valuation, and the recommendation summary that we came up with. So Pfizer is a top premier pharmaceutical or biopharmaceutical company in the world. They actually have sold products in 125 countries. Pfizer is traded on the New York Stock Exchange with a ticker symbol of PFE. Pfizer was founded in 1849 by two German immigrants in Brooklyn, New York. 170 years later, Pfizer has a New York City headquarters with just over 88,000 employees. The company's main focus is the discovery, development, and manufacture of healthcare products. So for the company segments, Pfizer actually breaks up their operational segments into three different ones. The first one is biopharma. Biopharma's main focus is internal medicine, oncology, vaccines, inflammation, immunology, and rare diseases. The next segment is Upjohn, and Upjohn basically provides products that are used to treat non-transmittable diseases. And some notable drugs that you might be aware of are Lyrica, Lipitor, Viagra, and Xanax. The next one is consumer healthcare. Basically, this segment just contains over-the-counter pain relief, vitamins, minerals, and supplements. You can see from the charts at the bottom, biopharma is leading in terms of revenue between the three segments, and it's increasingly taking over the lead from 2017 to 2019. The next up is Upjohn, that has about 25 to 20% of the revenue, and that's slowly decreasing, giving its to biopharma. And then lastly, consumer healthcare, as of 2019, it was only 4%. Another thing to take note from these charts is that in 2017, it's on the bottom, it has the 2017 revenues by geography. And in 2017, Pfizer's revenue was about 50-50 between the United States and international. As of 2019, they're branching towards being more international, and they're at 54% of the revenues in international.
All right, now just moving on to the industry overview. Pfizer is located in the brand name pharmaceutical manufacturing industry. And in this industry, there's really five major players. The first in terms of market share is Bristol Myers Squibb with 10.7% market share. And then close behind is Pfizer with 10.2%. And then AbbVie Inc. is Merck & Co. and Johnson & Johnson with 10%, 7.1%, and 6.3% respectively. And then just moving towards the industry outlook, the brand name pharmaceuticals are expected to expand over the next 5 years to 2025. The industry revenue as a whole is forecasted to rise at an annualized rate of 3.2%. And then these reasons for the increased revenue, this is actually specific to Pfizer. Orphan drugs are being produced. Currently, Pfizer has 12 rare disease drugs in the developmental phase. And these orphan drugs have low developmental costs and high returns. And Pfizer, for their drug pipelines, this is just kind of the pipeline towards phases of making drugs. And in those pipelines, the oncology, in the therapeutic classes, I should say, they have oncology medicines, inflammatory and immunology, and internal medicines. And then international trade, exports are anticipated to grow at 4% annually to $55.8 billion over the next 5 years. And this is as an industry as a whole. And then you can see that for Pfizer specifically in the graphs that Jesse just talked about. And then focus on Pfizer's product pipeline, and this is a little snapshot from October 27th, 2020. Currently, Pfizer has 92 total products in the product pipeline. And then I just kind of wanted to focus on the registration phase, just because these are the products that will be coming out in the near future. And those therapeutic areas of those 6, 3 of them are in oncology, 2 of them are in inflammation and immunology, and then 1 is in internal medicine. And just to give a little breakdown of the kinds of products that are in and how they relate to the revenue of Pfizer. Oncology in 2019 made up 17% of the revenue. Inflammation and immunology made up 9%, and internal medicine made up 18%. And I just wanted to point out that oncology has been growing year over year at about 20%. And in 2020, that is also true. They've been growing 20% over the same time period. So this was from the beginning of 2020 till September. So in 2019, they have saw a 20% increase over that same time period. And then just to take a look at the industry competitors, I wanted to point out that Pfizer's PE is above the industry average and currently above most of the competitors, or all at least in this chart. The PEG ratio is low due to slow growth, and but as we'll talk about later, with some growth opportunities, we feel that number can improve. Net profit margin sitting at 17.9%, just slightly below the industry average. But I would like to also just kind of point out that Bristol Myers Squibb, which is the largest in terms of market share, has been having quite a hard time with ROE, ROA, and net profit margin. Okay, now looking at some of the financial ratios. This was from the past, from 2017 till Q3 of 2020. I'd like to point out that in 2018, Pfizer saw a down year, and this was due to the loss of a patent for a drug that they made up a large part of their revenue, and that drug was Lyrica, and that was almost a $3 billion impact. So that's kind of why, in part, why these ratios are down, as well as they saw an increase in acquisition and restructuring costs. So before 2018, they had actually 2 business segments, but in 2018 they restructured it to the 3 business segments that Jesse talked about earlier, which are biopharma, Upjohn, and consumer healthcare. And then we see 2020 are down, ratios are down just slightly, and in our research we found that this is due to less people visiting the doctors, shorter hospital stays, and just decreased revenue in the early part of this year as a whole. And I guess another thing I wanted to mention is that because the loss of patents obviously affects revenue, they're not going to see the next wave of patent losses till 2026. And Hunter will get to that in the next couple of slides. And then the 3-year growth and profitability, this is over the past 3 years. We see a negative revenue growth, but again, we feel that our growth opportunities will increase this number. We also see that the net income is relatively decent at 31.14% and net profit margin at 17.85%. And then I just wanted to go a little deeper into the current stock price. So this was from December 10th. And throughout the year, the low was at $27.03, and that was on March 23rd. And currently, or at least at the date that this snapshot was taken, it was at its highest share price since June of 2019. And that's so from the low and March 23rd, it's been a 52% return. And from the S&P 500's return, since that's the benchmark of the Spellman Fund, there was a 49% return from their March 18th low. And then one thing we also wanted to point out was the dividend payments that Pfizer gives out. As you can see, from 2015 to 2020, the dividend payments increase by a total of 40 cents throughout the years. And then this has increased quarterly dividends by 2 cents each year since 2009. And now I'll pass it on to Hunter to show us a little bit more about the financials of how our growth opportunities will impact Pfizer.
Thanks, Ryan. So obviously, Pfizer's biggest growth opportunity at the moment is the COVID-19 vaccine. And as you might have seen, as of yesterday, the FDA did approve it, and we will see distribution and vaccinations as early as Monday or Tuesday of the fall of next week. So we found that there is a $100 billion potential market for the COVID vaccine. And since Pfizer is first to market with this vaccine, they could capture 40% of this $100 billion potential market. So Pfizer is releasing a 2-dose vaccine. So per single dose, they are selling it at $19.50. And the cost per dose is about 13.65%. So that's a 30% profit margin, which is higher than their overall profit margin, but still relatively low compared to other vaccines, just due to the distribution issues and the pace that this vaccine has had to be created and the urgency. So Pfizer announced that they could distribute 50 million vaccines in 2020. So through the rest of December, they could bring the net profit of $292.5 million and increase their EPS about 0.05. Then we'll see this having the biggest impact on 2021. Pfizer announced that they could at most distribute about 1.3 billion vaccines. But as we know, most of these vaccine sales comes from government contracts. So based on the government contracts that are currently in place, they will bring in about $3.5 billion in revenue in 2021. And then as more competitors come into the market and people are being vaccinated, those sales are going to slowly drop off through 2025. But since this vaccine is so early right now, we are not sure about how long the immunity is going to last, but there's definitely potential that this will be a seasonal vaccine. So that will bring in a solid revenue stream for the next decade at least. So yeah, we can see in 2021, the 0.63 increase in earnings per share will be a huge help to Pfizer and definitely increase their earnings. And we go on to the next slide here. I can show you some of the breakdowns of the government contracts currently in place. So the European Commission already purchased 200 million vaccines, and they are already being vaccinated in the UK. The US and Japan both had purchases of 100 million and 120 million. And you can see on the right here that there are options to buy more in these contracts. So the US could possibly purchase up to 500 million more vaccines in 2021, 2022. So with our optimistic EPS projections, that's what kind of comes into play there. That's a huge potential to boost earnings if those options are executed. So then moving on to our next growth opportunity, it'll be patented drugs. And to find the EPS of these patented drugs, we took the increase in revenue from patents and subtracted it from the decrease in revenue from expiring patents. So we can see in 2020, there is a drug that recently expired, which will decrease their revenues overall. But then we see in 2021 and some of the other years on that there is going to be an increase in revenue. And we really took a conservative approach to these projections since it's very unclear on how much revenue a new patented drug could bring in. But how we estimated the revenue was, I looked at the most recent drug patent and how much revenue it brought in the first year, and that was $407 million. So that's what we took to project increased revenues. But each drug has potential to bring in about $2 billion each year, depending on the need for it. And then to subtract the revenues from patent loss, I looked at Lyrica's percentage decrease in revenue from 2018 to 2019 to try to estimate how much revenue each drug would be losing when the patent does expire. And that turned out to be about a 44% decrease in revenue the next year following a patent expiration. So with this conservative estimation, you can see here that the increase in earnings per share is not huge, but there is great potential for some of these drugs to bring in billions across the next 5 years. And as Ryan mentioned earlier, there is patent cliff coming in 2026, but with their increased research and development, they're bringing drugs to market a lot faster than in the past, and this can definitely hedge those losses in the future. We'll move on to the next slide. We'll see the overall EPS estimations that we have. So obviously in 2021, the COVID-19 vaccine is going to boost sales greatly and provide them with a stream of revenue for the next decade. And they are currently recovering from the patent cliff they saw in 2020. And they are investing more in research and development and automation to bring some of the costs of bringing these drugs to market, and they're bringing them to market a lot faster than previously. Another initiative that they talked about in their annual report was protecting patents from generics and knockoffs. As you may know, generics and knockoffs definitely steal a great portion of Pfizer's sales. So as they increase their protection, they should see sales be a lot more consistent throughout the years. And with an optimistic EPS, you can see in 2020 of 3.35, that's going to be a huge increase from the 2.33 EPS in 2020. And you can see that it's going to drop off in 2022, but we think that those EPS projections are going to level out coming through 2023 to 2025. So I'll pass it off to Connor for the valuation.
So yeah, next we're going to look at the valuation that we found for Pfizer. So through our analysis, we found Pfizer to be slightly undervalued. We first calculated our free cash flow intrinsic value to be $54 a share. As we said before, it is currently trading at a much lower price, around $41 as of this morning. Like Hunter said before, we believe that the COVID-19 vaccine will increase the earnings per share in 2021 and is one of the big reasons for our higher valuation of $54 a share for this method. We also looked at the price per earnings method to value Pfizer, and from there we get a target price of $41, which is much closer to what it is currently trading at. So after we got those two numbers, we decided to average the two methods and get a total target price of $43. We placed a 80-20 ratio weight on the PE method versus the free cash flow method because we believe the PE method is more accurate and was much easier to estimate. This is where we see that Pfizer might be slightly undervalued, and it shows that it might be a good time to buy.
So looking at some of the risks that Pfizer faces, there's about 9 major risks. These include product liability, political risks, security breaches, increasing competition, patent expirations, counterfeit drugs, legal liability, FDA regulations, and shifts in technology. I'm just going to touch on the 3 major risks that they face. First being the legal liability, especially with opioids. So being in the pharmaceutical drug industry, there's going to be numerous lawsuits with misuse of drugs. And as I said previously, Pfizer is upping their legal team, and they should hopefully be able to fight against these lawsuits and win those. Moving on to patent expirations, this can definitely be a huge detriment to revenue. It's impossible to avoid, but I think that as they up their R&D, they'll be able to bring more drugs to market and bring patents that will kind of hedge the losses of the expiring patents. Then lastly, the FDA regulations. So FDA regulations are a huge barrier to entry for Pfizer because each drug that they are trying to bring to market has to pass through the FDA. So as I said earlier, Pfizer is upping their R&D. So as they improve their clinical trials, they will have, as you could say, their ducks in a row and be able to pass through the FDA much easier than in the past and bring those drugs to market. So moving on, we'll talk about the correlation matrix.
So yeah, looking at the correlation matrix, we first found the monthly returns of all the stocks in the portfolio from January 1st, 2015 through December 2020, and we compared them to Pfizer's monthly returns in that time frame. If you look in the first column and find the ticker PFE, you can see all the correlations that it has with the other stocks in the portfolio. And as you can see, that Pfizer does not seem to be highly correlated with any of the stocks in the portfolio, which is including the ones from the healthcare sector, such as Johnson & Johnson or CVS Healthcare. And that does show that adding Pfizer to the portfolio could definitely add diversity to it. So now looking at the summary, as a recommendation, we do recommend buying 130 shares of Pfizer, which would equate to 1.5% of the total portfolio. We do recommend buying, as we say, but not as a buy and hold for a super long period of time. As you can see throughout the whole presentation, it shows that Pfizer is set to make quick capital gains in 2021 and potentially 2022. And after that, we would recommend evaluating the stock before moving forward. Like we said throughout the presentation, the two big key drivers from the stock comes from its patents and the COVID-19 vaccine. The plan to increase R&D for the future is also definitely something to watch closely over the next couple of years. And then the 12-month target price is $43.77, and the percentage return that we expect is 6.5%. And even though this stock is low, we again recommending investing in the stock for a shorter length of time. And then that's all we have for our presentation. If you guys have any questions.
So I'll just start with just a quick point that you guys said that FDA approved. They haven't technically approved yet. I guess a panel recommended approving, but they haven't yet approved. Although I saw a headline that the White House orders the FDA chief to either resign today or approve the vaccine. So we'll see. No pressure on him, I guess. But I guess I'll start with a quick question, and then we can open it up to the board members. So if the FDA approves today and there's another bump in the price, would you guys still recommend buying, or at what price are you suggesting we buy at? It's trading at about 41 right now. Your target price is 43.77. So
yeah, I would still suggest to buy, just because assuming that the vaccine is successful, those options to buy and the government contracts could still greatly boost the stock price in the future. So if we see success after it's distributed in December, hopefully, and these countries do decide to buy more vaccines, those announcements could definitely increase the stock price even more than what it would be at if it is approved. So.
Can I follow up on that? So can you go back to your earnings where you showed the impact?
This slide?
Whichever one was, you showed the impact of it, the COVID vaccine. Okay. Yeah, there you go. First thing is scale this. Do you know what I mean? Tell me how much this is as a percent of the total, because the 18 cents or 32 cents, that doesn't mean much to me if I don't know what earnings are right now. Okay, I want to know how it impacts growth. So what is it? I actually looked it up. I know the answer, but I want you to know.
The current.
Well, I mean, it's 30. If the company is making $50 a share, 63 cents doesn't matter much. So how much are they making?
I think, let me look back.
Okay.
I got to look at it different.
Okay. And then I guess the follow-up for the question is, those options to buy more COVID vaccine, is that in these numbers?
Yeah, I think Hunter, he placed those in the this slide, or yeah, right here. Those are in the optimistic earnings per share.
Yeah, that's overall. That's not just with the COVID vaccine, though. So that would be overall optimistic, including the options. So
Okay.
You can see that there's 30-cent increase there.
Okay. Now, I guess my last question, and I'll let others ask, is really you only have them bumping up the earnings for 1 year, and then it's flat. There's really no growth going forward. Is it really worth paying this much for the stock? It's a little bit above the average PE for the market.
Right. Yeah. So I mean,
headlines. The stock could go higher, right? Because of the headlines, I think you said. But is the value there for the stock price?
Yeah. So I mean, historically, Pfizer has not been a high growth company. If you look at their revenues over time, they're growing pretty slowly. So I think that makes sense what we have. But one thing that was really difficult for us to look into is exactly how much revenue could a new patent bring in. I read an article that said that they could potentially bring in $15 billion in new drugs to market through 2025. So we went really conservative with the patent projections, only estimating about 407 million per new patent when it could potentially be up to 2 billion. So that is definitely a place where we can try to reevaluate, and when we get more information on these new drugs, see how much that could increase the stock price.
I've got another one. If you're done, Kevin. Guys, what is their exposure to opioids? How much of their portfolio is opioids, or what, I guess, is their brand name drug there where they have some legal liability? Did you highlight that one in there? Because it's not Lipitor or
no. I'm not sure. I'm not sure the actual name of it, but I know that if you can go back to the segment slide.
Give me a sec.
Yeah, so I didn't mention it in here, but the opioids actually do come from Upjohn, but I didn't write down the notable drugs, and I didn't write down, I didn't write down the actual name of, or what segment did they have in Upjohn, so. But it's in that segment, it's in the 25% segment, or the 20 to 25% segment.
It wasn't part of the recent spin-off, was it? So I think they completed a spin in November.
Yeah.
Something was.
I don't think it was. I think Ryan.
Yeah, I know opioids are a large part of their business compared to their competitors. It's relatively small compared to the industry, but they still are producing opioids. So regardless, there is that risk there. And that would have been something to look into more.
Yeah, and piggybacking off of that, I think it was earlier this year, Purdue Pharma was sued for, I think it was OxyContin for, I think it had to have been over $1 billion. So there's just always that risk that we run. I know not every drug is as popular as OxyContin, but it's still a risk that Pfizer has to manage.
Okay. So I'm asking because it also, I think Mallinckrodt Pharmaceutical also filed for bankruptcy protection earlier this year. They were, I believe at one point they were the largest importer of opium in the world. So they had significant exposure. I guess I've never really thought of Pfizer as having significant exposure there. Doesn't mean legal exposure isn't a significant risk for pharmaceuticals, but it does seem like the other folks didn't have the same cash coffers to weather some sort of a legal storm there. Yeah. This one's I owned this one. I actually had to duck away for a second to find my tax returns because I couldn't remember when I owned this one. And you're right. It is a slow grower. It is boring. You need to be patient with this one. And it just seems like when I owned it in 2011, there was concern about patent cliffs, whether it was Viagra or Lipitor or any of the other drugs that they have. They bought Wyeth Pharmaceutical to try to address some of those concerns. It just seems to be an ongoing 5 steps forward, 4 steps back.
Yeah.
In terms of, we added 5 new drugs and 4 of them fell off. Tell me a little bit more about, because you kind of talked about protection against generics. Can you go just talk a little bit, more about it? What are they doing? Do they have their own generics? Do they view the patent cliff as a significant risk? Like, I think of it as a significant risk, or is it just going to be an ongoing part of their business? And that's why we're only growing at 3% and not 30%.
Right. I think it's always going to be a risk of the company, regardless. There's going to be patent cliffs no matter what. Exactly what are they doing to protect against that? I'm not sure, but I do know that they are looking into expanding their generic drug business. So maybe when those patents do fall off, then they will have a larger market share of the generics anyways, to kind of hedge that risk of the brand names dropping off. So I think as they expand their generic drugs, they could kind of recover some of those lost revenues that they see from the patent cliffs. I don't know if Jesse, Ryan, or Connor has any more insight on what they're doing to protect against that.
No, that's pretty much what I read from a press release that they had.
Yeah, I think the only thing else you could maybe add to that is I did see that they're ramping up their R&D for the next 5 to 6 years. So I'm wondering if they're just keep trying to push more drugs to try and combat the patent cliff for their future.
Yeah, kind of going off that a little bit too. Pfizer did release that, I believe it was in 2017, that only about 9% of their products in their pipeline are making it to market, and now it's around 12%. So they are seeing an increase in drugs to market and the efficiency of getting them to market. And it does take about 6 to 7 years for a product to make its way through a pipeline. So regardless, it is a long process, but as new technology comes out and they improve their processes, they can hopefully get some more of these oncology drugs, some of these newer drugs to market and capture that market share.
I have
a couple more questions.
I have a question, or sort of 2 questions related. So health economists worry about the dearth of new ideas in drug production. That is to say that they're not finding them to be as effective in terms of life improving as they used to be. So my question is, I guess the first question, or first part of the question is, what are your thoughts on the pharmaceutical industry in general's future as they start to run out of ideas, right? Or sort of the perception is that the returns in terms of life benefits are diminished. So that's the first part of it, the question. So what are your thoughts on that drug development as a whole and its impact on Pfizer? And then the second one is that, this is an industry which is always a punching bag in the healthcare sector. It benefits dramatically from patent protections. They like to play games where they have new patents that are only marginally different than the old patents and aren't any more different in terms of their efficacy for health. What are some risks you see to the regulatory and the patent realm for pharmaceuticals in general in terms of the current political environment? Now that I understand our about to be former president has accepted the results of the election and will have a Democrat as president. So what are your thoughts on that?
So I'll address your first question about the healthcare industry not coming up with effective products. So what I've read about Pfizer is they're looking into biosimilars a lot more now. So essentially existing drugs and kind of altering them to improve them. So I think if they can find more effectiveness in the current market, that they could potentially capture regain some of the market share in certain segments. So if they can keep up with their R&D on the current drugs and make them better, have better results, less side effects, I think that could improve their current revenues as well. So yeah, like you said, I do agree that I mean, we're kind of at a point where some of these drugs aren't going to help quality of life essentially, but if they can improve the current ones, then they could regain some revenues there. And if Ryan, Jesse, or Connor can touch on the patent protection.
I'm not really sure I have a solid answer for you, but in terms of the new president coming in 2021, I feel like there's going to be some sort of drug reform. I'm not really sure on what kind. I think I didn't really do too much research on that. I know I should have. That wasn't really my focus in this the project this time. So I guess I don't really have a solid answer. I'm not sure if Jesse or Connor does, but I wish I would.
Yeah, I mean, I think I can touch on it a little bit. I mean, in general, with Democratic presidents, they're gonna have higher regulations on pharmaceutical drugs. So how long it's gonna take for those regulations to change, we don't know. But we could assume that there is going to be some political risk there of margins decreasing and potential revenue losses. So,
yeah, I mean, to me, Hunter, you said that the biosimilars are a place that they're sort of digging, and to me, that's exactly what ends up leading the politics of the day to sort of argue for less removing patent protections or sort of reforming patent protections. I think patent protections are valuable, but when you're patent protecting because you changed or tweaked some small side effect, it loses its argument, right? So I think that those things are related. The more people that go after biosimilars, the sort of more they devalue the argument that patents are important, and then they just look like they're, they call it what's the term in the patent world, but basically, drilling an oil well right next to the previous oil well and say, look, I discovered oil. Well, you're only hunting next to the other oil wells, right? You're not doing anything. So why did you need the patent protection to go out and discover stuff? So I mean, that combination, I think, is potentially, risky for these companies. I would hope that one of the things you do see coming out of the vaccine is that there's a critical eye on the FDA. And I mean, I don't like this White House much at all, but their sort of point about what's the point of a further delay. 3,000 people are dying a day. The value of the FDA in taking an extra day is seen very starkly for all Americans, and it might really signal that there should be some reforms to the FDA and how fast that process works for drugs, because we can do it faster than what we have done in the past. So anyhow.
Yeah, I totally agree.
Yep.
I'm going to piggyback a little bit on the political risk, looking at pricing. That's been an issue that's come up many times over the years, and I think it will continue to. A lot of different ideas on how to do that, but the latest one I saw was where we didn't want to pay more than the least is being paid by a developed country. Did you figure out what type of risk that would bring to the industry as far as dollars, quantitating it or quantifying it?
I don't think we looked into dollars, no.
Okay. Because that could be significant for the whole industry.
Yeah, that makes sense.
Definitely.
Say also, did I miss? I'm sorry, I had to step out for a second. Did I miss? Do you know the actual cost of a dose of the vaccine? A single dose?
Yep. So
price?
Pfizer, I don't know if you heard, but it's a 2-dose vaccine.
Yep.
So per dose, it's $19.50 to purchase, and Pfizer estimated about a 40% profit margin on that, but that was not including distribution and marketing costs. And obviously, as you know, the distribution has been an issue, keeping it at negative 70 degrees Celsius. So we estimated a 30% profit margin, so that would come out at a cost of 13.65. So
Okay. That's great. Good job, guys.
Good. To be clear, is that $19.50 or are we talking $1,950? Because with pharmaceuticals, you never know.
yeah, no, sorry about that. Yeah, it's $19.50
Okay.
to purchase. So for the 2 vaccine dose, $39 is what the government is purchasing it at.
Pfizer isn't owned by the Sacklers, or who was that dude who changed the price of insulin and got thrown in jail? Whatever.
Is that
Oh,
I don't know.
this one.
Yeah, I forget the guy's name. Anyhow, couldn't have happened to a nicer guy.
Yeah, right.
All right. Well, good
I
job.
have one
We should
question
probably.
if we have a minute.
Yeah, I guess we can have one more quick question.
This is more of a learning thing because one of the last statements that was made on the presentation was we should buy it for a shorter length of time. That's kind of wishy-washy. Can you be a little more specific as to what that means? Because I know Tyler, short length of time, that can mean a lot to them.
Yeah, I guess like more so look it over or take it and hold it for a year or so, because that's when most of the projected revenue from the coronavirus vaccine is supposed to hit their revenues. And then basically after that year, reevaluate and see whether or not you should sell some of the shares off, or see whether or not the coronavirus vaccine is going to be needed more than once for each person, or if it's going to be like a yearly thing. So it's more so just kind of like taking it year by year and reevaluating it and see where it's expected to go.
I think that, as we talked about earlier, with the slow revenue growth, it might be a good idea to, like you said, kind of evaluate it on a year-to-year basis. But to get significant returns, I think it's definitely a stock that you might have to hold for a while.
All right. The reason I ask is that, and this is kind of later in your careers, when you're given these kind of presentations, try to be as specific as possible, because that helps your target audience. I mean, if you go to your boss and say, yeah, I think we should do this presentation and then you give a not so specific answer, I think from a credibility standpoint, it's a little bit harder to make. So I'm using this as kind of a constructive learning point for you guys, so that when you're giving these kind of presentations later in the future, try to be as specific with your recommendations as possible, because it makes us as an audience understand exactly what you're trying to accomplish, versus being a little more vague.
Yeah, and thank you for the advice. We'll definitely be using that in our future careers.
Yeah, we appreciate the feedback.
Appreciate that.
Thanks.
Martin Skrelly was the farmer bro.
I was just about to say that. He's the farmer bro. All right.
All right. Well, we should probably move on to the next group, but good job, guys.
Yep. Thank you for taking the time out of your day to listen to us. We appreciate it.
Thank you.
Okay, so next up we have Excel. If one of you wants to pull that up, and I'll just remind our board members and faculty, if you can fill out the spreadsheet as we go along through the link that I sent.
All right, can we see everything?
Yep, you're good to go.
Sounds good.
All right, hello everyone. Hope you're all doing well today. Thank you for being here with us. My name is Sydney, and I've been working with Elliot and Ethan, researching and analyzing Xcel Energy and focusing on their stock valuation and growth potential. So we have a few important numbers here to start with. Xcel's current price at $66.61, and then their current PE is 26.25. Our target price is going to be $70.86, and then we've calculated our return to be 6.38%. I do think it's important to mention that these numbers have been fluctuating a decent amount over the past few weeks. And although some of our numbers that the stock has shown us have shown that that Xcel does have some potential, but we do see a lot of uncertainty with all of their investments in renewable energy going into the future. And we're just a little unsure about how that's going to play out in the next few years. So with that information in mind and the rest of our analysis, we are currently recommending a hold. So we can go on to the next slide here. Through this presentation, we will talk a little bit about the company background and then lead into business segments. We'll then go through Xcel's key financials, their growth opportunities for the company in the coming future, and then valuation analysis. And lastly, we'll talk a bit about the correlations between Xcel and the current stocks in the fund, and then make some comparisons to NextEra Energy, which is an energy company that's already in the fund. All right, so just a little bit of background. Xcel is based in Minneapolis, Minnesota, and then they provide energy to 8 different states in the US, which we have listed on the screen there for you with that map that shows it. We can move on to the next slide. Xcel's customer base right now is upwards of 5.6 million and growing. Xcel currently owns and operates multiple wind and solar farms, and they also have some infrastructure investments going on as well. They earn profit by charging rates per customer on the energy that they're providing. And finally, they are working on research and development of renewable energy. So I'll now pass it over to Elliot, who will talk a little bit about Xcel's business segments here.
Yeah, so the main 2 business segments of Xcel would be their electricity that they provide and natural gas. For the electric revenues, 31% are residential, 53% are consumer and industrial, and 16% are categorized under other, kind of a miscellaneous category. For natural gas, 62% are residential, 32% are consumer and industrial, and then 6% goes down to transportation. Going on with our business segments, looking at the past 3 years, the percent of revenues from both business segments have remained really stable over the last few years. But while those have remained stable, the customer base has grown each year. It's not a high growth, but it is pretty stable and it's trending upwards.
All right, so on this slide, we started to get into some of our key financial values for Xcel, and then we compared those to the utilities industry as a whole and NextEra Energy. So for these values, we looked at the 3 most recent years for the industry, and then for the industry average, we took the average of 2017, 2018, and 2019. So looking at the PE ratio first, Xcel is on par with the industry average, which pretty much indicates what we would expect from a utilities company, and that we will not expect much growth from Xcel. And then next, when considering Xcel's ROA and ROE, we can see that they outperformed the industry on their ability to generate a return in comparison to their equity and assets. And then arguably our most important indicator listed would be the net profit margin, which Xcel is nearly 3% higher on than over the past 3 years than the industry average. And while these values are positives from an investment standpoint, when thinking about comparing Xcel directly to NextEra Energy, we can see that Xcel still has a much lower net profit margin, PE, and ROA. And considering these factors, we believe that NextEra would still be a much better investment for the portfolio than Xcel would be. So moving on to our next slide, we're going to discuss some of our growth opportunities. And for these opportunities, we're going to focus on 2 main aspects, which are customer and territory growth, and then the expansion into renewable energy and that investment. So Xcel plans to expand and continue on the renewable energy investments that they have already began. And from these previous investments, they have already saved over $170 million in government tax breaks over the last year. And then just another small area of growth that Xcel has seen over the past few years is the 3.8% increase in energy consumption annually.
Moving on, talking about the dividend and PEG ratio growth. So for 16 years, Xcel has kept their annual dividend growth rate between about 5 to 7%. Their average dividend growth rate is currently at 6.6%. So this leads us to show our growth from what it's at right now in 2020 of 1.73. We think it'll be about 2021 1.84, and in 2022 1.96. And then looking at their PEG ratio, it has gone upwards lately, and at the moment it's at 3.64. And when looking at our valuation and projecting next year's PEG ratio, we believe it'll keep rising. So this isn't exactly what we wanted to see when looking at their growth potential. But when we projected it out further, it started to go back down in 2022 and 2023, showing hopefully from our valuation standpoint and our own projections that their investments into renewable energy will start to kind of pan out. Looking at the growth opportunities of renewable energy, currently this has added about 7 cents each year to their earnings per share. And we can also see that the renewable credit each year has been over 4 million, and it's continued to rise each year too. So this is tax credits from the government, which gives them not only gives them incentive to keep investing into this, but it saves them money too. Renewable energy sales are also required to be at least 20% of energy sales by the renewable energy standard in much of Excel's territory. And then when looking at Excel's projections, in 2017, they were already 40% carbon free. And then by 2027, they expect to be about 61% carbon free. These show projections of large increase in electricity production and usage by customers. And while the renewable energy and electricity, they're expecting a huge boom in, there's only a slight decrease in natural gas, because even by 2027, much of the world will still be dependent on it.
So moving on to our next growth opportunity, we're going to discuss the territory growth. So currently operating in only 8 states, as we said before, Excel has already began discussing about expanding into new territories. So we are projecting that they will expand into 1/3 of the nation. And then we assume that Excel's market share will carry over to these new states, which would imply that they would add approximately 5.2 million new customers to their company. We then projected that Excel's profit in 5 years would be up to $2,168 million. And this number was computed by multiplying the number of new customers by the average revenue that each customer brings in, and then multiplying that number by Excel's profit margin to get our final projection. And then lastly, we multiplied this final number by the annual growth of consumption, which was 3.8%, to give us a final profit margin of $2,250 million. And then one note to make is that we made these expansion projections largely based on an assumption, and we cannot guarantee that Excel will ultimately expand to 1/3 of the nation over time. So I'm looking into some of the valuations that we projected. We were able to project our pessimistic and optimistic scenarios for our growth opportunities. And by these, we were able to give a low and high target price range. Our baseline estimation used an EPS addition of 0.7 from the renewable growth opportunities, as we previously mentioned. And then for our pessimistic scenario, we used the assumption that the renewable growth investments would ultimately fail and have no impact on the EPS for the next year. For the optimistic scenario, our numbers were based on the assumption that the earnings per share growth from the renewable energy would double from our original expectation, and that would add an EPS of 1.4 annually. And then continuing on our valuation, currently Excel is priced at $66.61, and we have calculated a target return of 6.38% over the next year. Comparing Excel to our valuation calculations from the previous slide, which gave valuations of 75.76 and 70.86, we can conclude that Excel is undervalued currently. However, we still recommend Excel as a hold, as it is too risky, and NextEra seems to be a better fit for the Spellman Fund overall.
All right, so compared to the stocks that are already in the fund, Excel does have a pretty low positive correlation to most of the stocks. The only negative correlations that we do see are between Excel and JP Morgan, and then Excel and Turtle Beach. Both of these correlations are below that negative 0.07. And then we also see a few higher correlations with Excel, including with Coca-Cola with a positive 0.54. And then with J&J with positive 0.5, and then NextEra was the big one with positive 0.08. So the NextEra correlation makes sense considering they're both in the energy sector and the similarities between the two stocks. The high correlation with Coca-Cola and with J&J is most likely because these are generally also stable stocks. And since we already do have those in the fund, we don't necessarily need more stock like that. On top of this, Coca-Cola and J&J have showed to yield higher dividends than XL. And so it makes sense that those would be the better option for now. And then we'll move on to the next slide where we're going to talk a little bit about NextEra compared to XL even more.
Yeah, so when looking at XL versus NextEra, we can see that XL has a higher ROE, a lower ROA, a higher earnings per share, and then a higher average dividend yield. But when actually looking at the annual dividend payout, last year XL's was 1.62, while NextEra's was 5. So clearly they're giving a much better dividend payout, and they have similar prices and investment plans. And also, XL's PEG ratio at the moment was 3.84, and NextEra's is 3.22. And both utility companies, as I mentioned, have similar prices and similar investment plans, and they also have a pretty similar customer base. But because of XL's such high capital going towards their renewable energy investments and the states that they're in, they're really there's a lot of regulatory issues, and they're really dependent on those regulatories and government legislation really for their investment plans to actually work. So NextEra still has more growth opportunities and a better financial report as of now. But some clean energy investment suggestions that we thought were Solar Edge Technologies, who has a PEG ratio of 1.65, Enphase Energy Incorporated. For an ETF, we had iShares Global Clean Energy, and then Sun Power. These are all pretty young companies with, we think, a huge upside and a lot of growth potential. And especially with the new administration probably coming within January for our government, we think that there's going to be a lot of infrastructure changes for clean energy, a lot of more support and a lot more funding. So really, we think maybe Excel's not the best plan for this fund or portfolio, but we still think some clean energy should be added to it.
Yeah, so just to sum things up a little bit here, our key drivers for XL are their growth opportunities, which are the customer growth and territory expansion, as well as that renewable energy expansion in the future. As we just talked about, XL may not be the company for this, but we do strongly believe that renewable energy, a company involved in renewable energy should be in the fund because of the growth that is expected to be seen in the renewable energy sector in the coming years. It does kind of seem like NextEra might already fill this position for the fund. And then finally, we just have a few appendix slides at the end here with some extra information and some of our calculations there. And so that is all we have for you guys. Thank you so much for your time. And we would now like to open up the floor for questions from you guys.
I'll just start with a couple quick things. And one thing I'll point out, just in case others notice the same thing, and I'll take blame for this. I should have spotted this before, right? But when you're comparing the two dividend payouts of Excel and NextEra, right, what really matters is the yield, right? Because the price per share of those two are different, so you can't just directly compare the payout. So the yield is really what matters, right?
Yep.
So just, and then my second thing is, I don't know if you were in the presentations yesterday, we asked another group the same thing that was recommending a hold. What price would you recommend we buy Excel at? Is there a price you have in mind? If it fell to this price, then it would be a good investment?
Personally, I think it's been currently dropping even more. And I think when I looked at it, we all looked at it like maybe an hour before this, I think it's now even down to 64. I think if it hit around 50, between 58 and 60, I think it would be a decent buy, because their high was at like 77 just a month ago. But with all the regulatory issues, and then with COVID also in the play, and many of their investments haven't even really panned out yet, and they're also still waiting on legislation to pass for some of them. I think it's still just kind of risky right now because we're not sure how those are gonna really work yet.
Okay, so maybe a limit buy at 58 or 60 you think would be a good idea?
Yes.
All right. All right, so we'll open it up. We can have about 20 minutes or so of questions. If anyone wants to go ahead.
I just have a comment and a question. I think the $5 dividend is no longer correct. That was $5 before the 4-for-1 split, if not mistaken.
Okay.
Because their dividend's been, usually under 2% or right around 2%, and $5 on $73 would be much more. So I'm guessing that was a pre-split dividend.
Oh, okay.
So did you ever look back 15, 20 years ago to the price earnings ratios on utilities average?
I don't think we did.
Okay. They used to trade at a much smaller price earnings ratio than they do now, partially because they're usually not fast growers, they're just steady growers. Why do you think they're selling at 26 times earnings right now?
I mean, personally, I guess I'm not really sure. I don't know, Ethan or Sydney.
No, I don't have much to add to that either. I guess I'm not really sure.
Well, basically, and this is my guess, these are surrogates for bonds and CDs and so on. In other words, their yield has often been used as a substitute for the low interest rates right now that we have. That makes them very popular. They've sold where they at times have yielded 7-8% because you might be able to get 3 or 4% in a bank. And that's what they're doing now, except they're coming off of basically a zero base of what's being paid in the bank. So their price earnings ratios have gone up a great deal. And you have to kind of look at utilities somewhat as something that's being invested in for the yield more than the growth.
Okay. That makes sense.
Yeah.
Bob, I was going to ask a very similar question, so I'll go a little different route with mine. If we go, first of all, a comment, if you can go back to slide 12, real quick, I've got a question comment on this one. First of all, comment, looking ahead, 2020, 21, 22, over the right, when we're talking about earnings per share, I don't know that we need to put a total because we're not looking at the total earnings. We're looking at growth year over year. Okay. So I probably wouldn't have included that from a presentation perspective. Percent of earnings. So that's the what? Renewable percent of earnings, profit margin. What number are we showing there? Is it the percent of total?
If I remember correctly from our actual paper, I believe it's percent of total earnings, and that this accounts, the territory growth accounts for that.
Yeah. The expansion of new territories.
Yeah, based off how many new customers they would receive and the profits from those customers. I believe that's what it is.
So 46, again, if I'm looking at 2020, 46% of earnings growth is coming to the acquisition of new customers through expansion. So. Okay. So my question isn't actually related to that. My question is, we talked about Nextera. You continue to talk about Nextera. The one thing stood out to me, but what was the one thing for you that, is there one ratio or one number you're looking at where you'd say, this is why that's a better fit than Excel?
There wasn't, I mean, other than it having a lower PEG ratio, I just, like, looking at their history, I feel like Nextera has been a lot more stable and not so volatile in the stock market. Excel's been constantly up and down. And I mean, now that we have a better understanding of the dividend yield versus dividend payout, it might change a little bit, but a lot of Excel's investments and the growth that they are projecting they're still waiting on information about that. And then when looking at like the current information for NextEra, a lot of them, they've already started working on a lot of their investments with renewable energy. And that's why they've been so popular for green energy enthusiasts, I feel like, in the stock market.
Sydney, do you have your
No,
hand up?
sorry, that was an accident.
So here's what I saw, and this is why I was asking the question. The PE ratio for Excel is lower than NextEra. The dividend yield is higher for Excel than NextEra. The one thing that stood out to me, though, is NextEra is growing at a faster clip. So when you take the two PE ratios and adjust for growth, the PEG ratio for Excel was lower than NextEra. So I thought that's where you were coming from, was on a relative basis, the NextEra earnings are cheaper than the Excel energy earnings. So that's one of the things I might have looked at there.
Okay.
Can I share my screen really quick? I want to ask a question. Sorry I wasn't in your presentation earlier. I had to step out, but I want to show you something and then have you guys explain it to me, you know, what's going on. This is a software that UWL La Crosse has. We just need to get password programs so you can share it. So I have that's Excel up here, which I think is the one that you presented. Is that correct?
Correct.
Okay. And what you see here in the blue is the returns of Excel versus the Russell 1000, basically large and mid-sized stock. So you can see it's been outperforming over time, but there's periods of time when it actually does poorly, which that's the aqua, okay? And those periods of time it does poorly are associated when this blue line's going down. And when the blue line goes up, you know, the stock outperforms and it goes down. Now, recently the blue line is going up. Okay, now this blue line is changing something called EVA. And EVA is associated with three things down on the bottom. Sales growth, which is the gray, okay? Negatively correlated with capital growth. This is them investing over time, and their capital percent of sales is going up. That's actually bad, okay? It's actually bad because you actually want to have more profits, but you don't want to invest as much in it to get the profits. And the blue line is the profitability. So when I look at this chart and I see it works pretty good for predicting whether this outperforms, okay? This blue goes up, all right, when their profit margin rises, but their capital doesn't, okay? So they're inversely, so notice here the capital was rising and the profitability was going down, the blue was going down and red was going up. That's associated with this happening. And that's associated with the stock underperforming, which is the aqua. So really the key, based on this chart, says, if you can prove to me that profitability is going to continue going up and they don't have to invest as much in capital, I want to buy it. So what will drive profitability up for them? Basically quicker than capital's rising. It's really, why will the profit rise quicker? And it's actually, all this is percent of sales, but why will the profitability rise quicker than their capital?
Yeah,
capital is like property, plant, and equipment, right? Profitability is earnings.
So the reason we touched on renewable energy so much is because when they invest in that, this allows them to provide energy for a cheaper cost for them. And when they own the actual wind farms and the infrastructure that provides this allows them to make rate-based investments. So this is how I think, and we think, they will be able to make more profits without spending less money. But the reason we don't think they should be a buy at the moment is because this is really all depends on how those investments plan out, how quickly the regulatory legislation pans out, and when they're actually able to start creating more and more wind farms like they have plans for.
Okay, so Elliot, and anyone can answer, are most of their investments already made then?
They have a couple big wind farms in Texas and a solar farm in Colorado, and they've already seen a reduction in cost and an increase in earnings from those alone. But they have a bunch more that are in writing. They have the capital ready to build them. They have the plans and everything, but they're waiting for legislation from, I believe, Wisconsin and another one from Colorado.
So this is what happens is if they go out and build them and they don't sell the energy quick enough.
Mm-hmm.
So this actually reminds me like the suppliers to Boeing. Or even Boeing. They go out and spend all kinds of money on R&D and their cash flow just goes down, and it's not a good time to buy Boeing. When they start selling the planes, all right, now they've already spent the investments, right? That's the time to buy Boeing, because then, and they go through the cycle where they actually have to design the new planes. Then Boeing does poorly during that. When they sell the planes, they do well. So you're telling me they're about to start the investment cycle.
Correct.
And that's bad, because if this red line goes up quicker than the other line, which is profitability, that's when all these blues went down and the stock underperforms. So you probably want to say to us, wait 1 to 2 years, keep this on our horizon. And I think that was your recommendation now that I hear it. I thought it was a buy at first.
No, it was a hold for now and keep a lookout for their investments for them to actually start making the money from them.
Okay. All right. I'll stop sharing now. And that would fit what we just saw. All right. That would be a good idea.
I'll quickly ask the question that Tyler really wanted to ask when he was talking about the expansion opportunities. Can you guys maybe go in a little bit more detail as to what you mean by those expansion opportunities? And you talked about a third of the country. And I guess I'll get to the punchline because we're probably running out of time. But you know, here in Milwaukee, I can only choose Wisconsin Energy because of the monopolies of the utility space. So I'm curious as to how you think they're going to go about quote unquote expanding.
So like with legislation passing, let's say California, where they're making it, mandatory to provide clean energy by a certain year. Xcel is one of the few utilities that they were first to start really investing into that. And I think they have the biggest growth in the renewables so far in the utility sector. So there was more of a projection on our side of, we think maybe some states will reach out where they want Xcel to expand for their territory because they're going to be wanting them to use clean energy. So it was more of a projection on, we think they're beating a lot of the utility sector or utility providers in the sector to this renewable energy standpoint.
So I guess the follow-on question have you seen instances where two utilities are able to work in the same jurisdiction, so to speak, because I'm guessing like if I'm in California and I'm, I know there's a PPG or PG&E or whatever, the wildfire company, they're obviously in a bad spot, so probably a bad example, but I'm assuming that they're probably also investing and they don't want anyone coming in and stepping on their toes, especially again, kind of in the highly regulated, monopoly style industry. So I guess, again, have you seen any instances where there's two kind of utilities working side by side in a various jurisdiction?
Yeah, no, I guess not. Yeah, probably not.
Yeah, and that was kind of an optimistic projection that we had as, just an opportunity. It is a growth opportunity, but I was thinking, just if you look at, I don't know if we still have that PowerPoint shared, but we did have the map of where they currently are. So it's, like those Midwest states, and then it has like Texas down there and stuff too. So there's that gap in the middle where, I don't know, like you said, like there probably, is somebody already. It might be hard to, but all that, where they could connect, that's kind of I think what we were looking at. Like, I guess, know exactly how they would do that, but yeah, just in general that could potentially be an opportunity in the future.
So
If that makes sense.
Yeah, I guess what I would suggest is that, or what we've seen in the past for expansion opportunities, it's more through acquisition of other utility companies than it is actually going in and trying to compete because of that, again, monopoly system that's in place.
All right, that makes sense.
Yeah.
A question for those that know more about energy. Do some, like if they start a wind farm somewhere, don't they sell to the grid then?
Yep.
And if a company gets into a regulatory bind where they have to produce or they have to provide more clean energy, can't they then buy from the grid or buy from one of these producers? So is there something about Xcel that says they have a much better ability to both set up these sort of clean energy sites and then distribute to nearby grids that might be facing this increased regulatory hurdle?
Yeah, I don't know how much they like buy and sell to other grids exactly, but I know they've lately been doing a lot of projects where they're getting brought in from, I guess, whoever, like the states they're in, and they're upgrading grids and they're making money that way by services for that. And like the wind farm they have in Texas, I'm assuming they sell off some like the energy that obviously they don't need it all perhaps, or whatever, like they might be selling it to other grids, but I'm not entirely sure.
I think that there's a whole industry. It's called cogeneration, and California has had some of that. And basically, what you're doing is you're selling wholesale to the monopoly, basically, in each state.
Okay.
Guys, if you go back to your slide in terms of the customer makeup, where you have residential and, so can we tell from here what portion of that, or if a portion of this is more wholesale versus, me as a utility customer? In this case, it might be We Energy's buying from Xcel. Is that on here? Is that what the CNI is?
I'm not, so consumer and industrials is what CNI was. I'm assuming the residential is going to be strictly the, Xcel providing energy through the grid to their customer base. I'm thinking maybe consumer and industrials might be, but we didn't really look into that too much.
Okay.
We can have time for one or two more quick questions if anyone has anything.
I guess if we got a minute and no one's going to ask, we talked a little bit about the regulatory environment. Do they have any rate cases coming up anytime soon? Is there anything in the backlog, or are they pretty much, is everything kind of set in stone? So I know, typically, TJ, relax. Typically, there'll be a government contract and they can adjust their rates after such and such period. And then once they kind of lock them in, whatever that rate might be, for a certain time, it kind of helps with your earnings stability. I was just kind of curious if they had any important rate cases coming up, because I know sometimes investors get a little nervous, especially in regulatory environments that are a little more volatile, where they start worrying about the ability to get their kind of growth built into that contract.
So like I was reading with these regulatory measures and their investments, maybe in a few years, once they start actually making money off those investments, that they were already thinking about, the government coming in and checking on their rates and like kind of capping them almost on some things, as you mentioned. So yeah, but I don't think there is any at this moment that I've read about, but probably in the near future.
All right. So maybe this is a good place to stop. Good job. Can stop sharing the screen and we can move on to our final one for today, the NVIDIA group. So one of you can share your PowerPoint.
Okay. I can probably pull the PowerPoint up. All right. Is everyone able to see the PowerPoint?
Yeah.
All right, we good to go?
Yeah, I'm good to go whenever you are.
Yeah, go ahead.
Alrighty. Hi, everyone. My name is Griffin Swatala, and alongside Paxton, Kylan, and Kyle, we're here today to give our recommendation on whether NVIDIA should join the fund. So right now, NVIDIA currently sits at $514. It's got a PE of 84.44. Our target price is at 408, which would give us a target return of negative 20%. And so we're recommending a sell. So we're going to go over why we recommend that then.
All right, just to go over a quick outline. First off, I'm Kylan, so we can get names out of the way. And first off, we'll start with the company background and talk about their business segments, talk about how NVIDIA makes money, where, the split of the revenue segments and how that's looking, and if we can really look at what's growing and what is the main driver behind NVIDIA's revenue. After that, we'll go into their key financial ratios and compare that to some competitors, see where they're standing against the industry, against one of their main competitors. And we'll talk about their growth opportunities and take a dive into how they're going to eventually grow revenue and hopefully grow their earnings to hopefully become, well, I guess in our valuation they are a sell, but see what they're looking for in the future to hopefully bring that up to maybe a buy recommendation in the future. And that'll go into our valuation and our recommendation, and we'll kind of talk about how we think it fits in the portfolio right now, why it may not be the best fit, and with our valuation, why we're recommending a sell. And eventually we'll wrap things up with our closing summary.
Okay, so who is NVIDIA and how do they make their money? So NVIDIA is a large cap stock right now within the technology sector. And how they make their money is based off the manufacturing and sales of their GPUs. Now this can either be their integrated GPUs or their discrete GPUs. So there could be a little bit of confusion as to the difference between these two, so we'll go into that a little bit now. And so an integrated GPU is going to be a much smaller GPU that is integrated within the motherboard or the CPU of a certain computer. It can be in a laptop, it can be a built PC as well. They're generally less powerful, don't need to be cooled as much, they can't render as many things. A discrete GPU is rather big though, and can be cooled really well by all the fans, as you can see on the right side of the screen there. This is great for gaming, which is great for NVIDIA as it is a big growth opportunity that they have, as Paxton will be able to talk about later. They're overall more powerful and just better for certain things around AI, supercomputers that can have them, as well as gaming and streaming, as I just mentioned before. So then we'll go on to the market share of these two. So right now, NVIDIA holds around a 19% share of the integrated GPU market and around an 80% share of the DGPU market. In the discrete GPU market, when they do hold the 80%, AMD holds around a 20%, while Intel holds 0. However, Intel has announced they are going to be coming out with some discrete GPUs, so we will see how that goes in the future for them. But as of right now, as you can see as well under the graph to the right, NVIDIA does hold quite a bit of a good stranglehold on this market. And then if we go to the next slide here, we can see the integrated GPU market visualized, as you can see, and as you may already know, as Intel is within the fund already, they do hold around 60 to 65% of this GPU market, while AMD and NVIDIA are around the 18, 19, 20% mark. And so to see how this is all going to funnel into the revenue segments for NVIDIA, I'm going to go ahead and hand it off to Kylan for the business segments.
All right, so I'm going to start off by talking here about showing their pie charts of the percentage of these revenue splits over the last few years. Now, they only report revenue in two segments, and that is these GPUs and something also called what's called a Tegra processor. These Tegra processors, they're the best way to describe them is if you look at the dashboard of, say, a Tesla or one of those electronic cars that they have those touch pads, kind of like an iPad on the dashboard. And those Tegra processors are really key for making those work and making sure they're reliable. But the GPUs overall stayed around that 87% consistently over the last few years of their revenue. And that'll take me into this next slide here. This is pulled from their most recent 10Q. And you can see over the 9 months ended where gaming and these data centers are most of the revenue. And that's mainly where these GPUs go towards. The discrete GPUs obviously go towards gaming, and gaming is their biggest revenue segment. And the other biggest revenue segment is the data centers, and that's the data centers, I guess, are more along the lines of supercomputers, those giant things that store a jumbo of information. Companies need them. Even more personalized, people are starting to go into these data centers as well for various reasons. And the Tegra processors, like I said, are in that automotive section and these other professional visualization and OEM sections as well. And then this graph on the left is showing just in the dollar amount, the revenue by year in the same years. And you can see there's the upward growth, the upward trend line of the GPUs and where that's heading. And we'll dive more into that into our growth story once we get to that, with Paxton talking about the growth in gaming and the growth in that discrete GPU. On the right-hand side, this graph from businessquaint.com gives a good representation of the revenue by geographic region for NVIDIA. Their biggest regions are over in the Asia Pacific with China, Taiwan, and some other countries around there. Those are the bars that are making up most of all these individual years and quarters. One of the main takeaways we wanted to talk about from this graph, though, and we agree with what this graph is trying to say, is that top right corner of the graph, the United States is that top tan color on each bar. And they're kind of predicting going into 2021 that revenue in the United States is going to jump up quite a large amount. And we like to think that a lot of that's due to the coronavirus. A lot of people are working from home. A lot of people are they're getting quarantined and they need more entertainment. So they're going for these computers so they can have some entertainment and have some video games. And they're also working from home. So they're going to need these computers to work from home as well.
So looking at their financials, there's a lot of numbers here, but the two I really want to look at is the PE ratio and the PEG ratio. So looking at NVIDIA's PE ratio from 2018, 2019, and now 2020, it was initially bigger, but then in 2019, the price dropped a little bit. But now in 2020, because of coronavirus, it's a lot higher at 84. Before this third quarter posted earnings, it was actually, I think, around 96. So really high up there. And same with AMD, as they're both in semiconductors and making GPUs. Coronavirus helped them increase their price a lot because a lot of people think, oh, coronavirus, everyone's going to be at home. Maybe they need new computers. Maybe people are just playing games because they're staying inside more. But either way, it made the stock price double. And so that's why we're seeing a really high PE ratio right now. Along with the PEG, a PEG above 1 is obviously not good. It means that the stock probably is overvalued a little bit, where you normally want to see a good value to buy at under a 1 PEG. And I think that those are the two numbers that mainly give us a good idea as to why NVIDIA might be a sell, because it's at a higher value because of Corona. On the bottom, we have the estimated PEGs for what we think the coming years will be. As you can see, it does get lower as our earnings increase for each year. So I think eventually it will start to die down and the growth will become more stable. And we can talk about the EPS growth in the coming slides. So looking at the valuation, these are for the optimistic, baseline, and pessimistic. The free cash flow method for the optimistic gave us 121, baseline 73, and pessimistic around 20. And obviously those seem really low. And I want to bring up that they seem low because NVIDIA is supposed to have really explosive growth in the coming years. And with a terminal growth value of 0.03%, it's just not going to show the value in the free cash flow method. Whereas on the PE method, it shows a much higher value to where you might actually seeing the baseline are optimistic, you might even think of buying it. However, our target price using a weighted 40% towards the free cash flow and 60% towards the PE method, we got a baseline target price currently of $408, which would, like I said earlier, give a target return of 20% loss. And so these were the EPS estimates that we had. Looking at or if you want to look at the graph to make it, more visually easy, the optimistics on the top and pessimistics on the bottom with baseline in the middle. Our idea is that optimistically, NVIDIA has continuously good growth after COVID, and that their ARM deal that they are in the process of goes exceedingly well, and that'll have great earnings for their future years to come. Baseline, I still think that NVIDIA is a strong company. It's just overpriced. So they most likely will continue to see growth in their EPS at a rate of about 25%. And the pessimistic, I still think that they're not going to lose money, but it's just not going to be as explosive as we'd like to see.
So as far as growth opportunities, we identified two key factors for NVIDIA. One of those factors being increased demand for their DGPUs, those GPUs that are used in gaming, as well as use of AI through their data centers. I would like to ask the listeners, if they have a teenage son, how often does he spend playing video games? I'm assuming it's pretty long. So we expect huge growth in gaming in the future, as well as AI is the future. It's what businesses are going to use for analytics. And right now there's a rat race between the tech giants to see who can develop the most advanced AI, because whoever has the most advanced AI generally has a huge leg up on competitors. So next I'm going to go over their DGPUs, and primarily these are used in gaming computers. They're the highest end and most cutting edge technology that you can put into a computer as your graphics card. And we identified that gaming revenue is up 33% from 2.27 billion year over year. And a large portion of NVIDIA's GPU revenue is from these DGPUs. In fact, that number is 80%. So 80% of all of NVIDIA's GPU revenue is coming from these GPUs. And you can see some visualizations of that. That top graph right there shows NVIDIA's market share relative to the entire GPU market. And then at the top there, you can see how much of that GPU share is taken up by their DGPUs. At the bottom of the slide, you can see that we identified the contributions to the EPS that the GPUs will be contributing. So at the far left, you can see the revenue market. At the bottom right, you can see the revenues generated by the DGPUs. So we took the market size, so that would be GPUs or NVIDIA's revenue from GPU sales, and then we forecasted that out to 2022, and then we took that 80% and multiplied it by their GPU market size to get the revenue market from the DGPUs. We kept that market share fairly consistent because we figured that they are already, they already can own 80% of the market share. There isn't really much room for expansion there. It's highly unlikely they're going to get that last 20%. If anything, they're most likely going to lose market share as Intel and other competitors develop better GPUs to catch up. And then at the bottom left there, you can see that their DGPU percent of their total revenue in 2020, that was 45%. And then we forecast that it will continue to grow alongside their GPU growth. And you can also see the percent contribution that the GPUs have to their EPS. So it contributes about 50% to their total EPSs. The next factor of their growth that we identified was their AI data centers. So first off, I mean, what are these AI data centers? You just think of it as giant rooms of servers that are used for cloud storage, as well as deep learning for NVIDIA's AI algorithms. And basically what that is NVIDIA is developing artificial intelligence to be used in their GPUs. This artificial intelligence includes things such as finishing Photoshop for you. You can tell your computer to Photoshop a candy cane into whatever picture you want, and it'll do it automatically. You won't have to do anything yourself. And that's technology they already have, and they're continuing to advance that technology. Their big competitors in this are the major tech giants such as Amazon Web Service, Google Cloud, Microsoft Azure, and IBM. The interesting aspect of this, though, is that each of these competitors has a specific objective that they're trying to accomplish with their artificial intelligence. Like Amazon Web Service is looking to optimize like data collection, whereas like NVIDIA is trying to optimize artificial intelligence for graphics. So they all kind of have different objectives that they're trying to reach with advancing their AI, but it is still overall competitive marketplace. As far as revenues from their AI data centers, it's kind of hard to identify because they don't publish much about it. But from what we were able to gather, Q3 revenue was 1.9 billion, up 8.5% from 1.75 billion in Q2 this year, and up 140% from 792 million from last year, Q3. And at the bottom there, I kind of did a similar calculation as I did with the DGPU, where I took the percent of total revenue that the AI is contributing and then just attributed that to the EPS. Finally, I thought we would touch on the ARM acquisition. So NVIDIA is currently in talks of acquiring ARM, another tech company. ARM has intellectual property licensing over micro CPU chips. These micro CPU chips are in almost every smartphone on the planet. And so with NVIDIA purchasing ARM, they will not only have access to producing GPUs, artificial intelligence, but they'll also be producing these CPUs that are in smartphones. The transaction is currently valued at about $40 billion. It's been hard to do any analysis on the merger because ARM is a private company, so acquiring financial data is rather difficult. But it's currently pending regulation review from the European Union, the United States, Japan, and China, because this is such a large merger and could lead to antitrust issues. Next, I will pass it off to Kyle to go over some of the risk factors with NVIDIA.
Okay, so right.
I'm not sure where the PowerPoint went.
Well, so we do have our risk matrix here in front of us, and we're mostly going to focus on the top right portion, so the red square up there, and we're going to look at two of the more risky things that are going to be going on within NVIDIA and their future. And so there's going to be the stock is valued as being quite overvalued, as well as there is going to be possibly some strong AMD GPU growth. So first, we'll hop into the stock being overvalued. As we've seen in all of our valuation numbers, even the optimistic numbers that we've been able to gather, the target price that we're looking at in the next couple of years here is around $450, as we've said. And so we don't believe that the price is going to go any higher. And so it is a risk to jump into the stock right now, especially to put it in our portfolio that is more heavily weighted towards technology. So we believe it is better to kind of hold off for now. And then probably the biggest risk factor here is going to be the possible growth of AMD and their GPUs. As you saw in one of the graphs earlier, right now they hold a 20% market share within the DGPU market. But more and more people, especially my roommate, he enjoys gaming. He has built his own CPU, his own PC, and he has used AMD within it and AMD GPUs. And so we do believe that if this does happen, it's going to be a huge hit on NVIDIA. As we have mentioned, the GPU is the biggest revenue segment of NVIDIA. So that right now is our biggest risks for NVIDIA going forward. And so then we end up here at our recommendation. Again, we are recommending a sell, or rather we are recommending that for the Spellman Fund that you are going to look for a better price entry point. We believe, again, over all of our valuations, that a price of $515 is way too high. I'd say buying around the 400 to 415 to 430 margin is probably a little bit better. Buying right now obviously represents a lot more risk, as we do believe that the stock is going to fall in the future. But then when we look at the Spellman Fund, we do see again that technology holds a weight of nearly 30% within the fund. And so as much of you probably would agree, we don't want to oversaturate that sector. We don't want it to weigh too far in one area. And so we are recommending that sell here. As for our recommendations for further in the fund, I will hand it over to Griffin for Turtle Beach.
Yeah, thanks. So I think Turtle Beach could potentially be a good sell here, seeing that it has been up 100% since the start of the year. Obviously, Turtle Beach has to do with headsets for gaming, and with Corona, gaming, obviously, like NVIDIA actually, they're pretty similar in how their growth is, because both of it's related to gaming, staying home. I think the difference here is that Turtle Beach prior to COVID was on a downtrend, and it stabilized and consolidated around that $8 mark, $9 mark, where I think the fund bought it at. And right now it's up to 20. And personally, I just don't see it going that much higher. It doesn't offer dividends. Although it is got a low PE and it's probably quite safe, I just don't see the growth there. And I think we could probably move the $5,000 that it makes up into something maybe more beneficial with higher dividends, and something like Intel. I think that was what we kind of talked about. That's all for that.
So I'm sure you guys have probably seen this from many other groups. And since we are recommending a sell, we don't really need to worry too much about how NVIDIA fits into the portfolio. But some key things to note are high correlations with obviously the other tech stocks in the portfolio, such as Adobe, Google, Apple, especially Intel. Intel is probably NVIDIA's biggest direct competitor. But thought we would just show you guys a quick visual of how NVIDIA would fit into the fund if we were recommending to buy.
And to close up here today, we've seen NVIDIA as an industry leader within the DGPU market. Whether that is going to increase or not is still anyone's guess. The obvious drivers and the growth factors right now are within gaming, especially with the rise of streamers, as well as AI and the ARM acquisition. We do, however, are expecting some short-term growth within probably a year or two, but after that, we don't expect much else. We do, again, however, see that the target price is much lower than it is right now. And if you were to buy, it'd be a negative 20% revenue on that as well. And again, we believe that the price is significantly overvalued, and thus we recommend a sell. we do not believe that it fits into the fund particularly well just because of how saturated, again, the technology sector is for you guys. So I do believe that possibly adding into some more funds into Intel, since they are coming out with their own discrete GPUs, may be a better option. And so that is all for our NVIDIA report here. And if you have any questions for us, please let us know.
Yeah, so I'll just start with a couple quick things. So I'm sure you guys saw sort of the class recommendation was to sell Intel, or sell, think about 1/5 of our shares of Intel. So I'm guessing you guys disagree with that, and you think we should actually buy more into Intel?
Yes.
All right. And my other comment before we open up for questions, I don't know if you guys felt the same way. It's kind of scary that AI can start doing Photoshop. Opens it up more for. I'll just state here for the record that if there's ever any compromising pictures of me out there, they came from an AI Photoshop. So
I hear they could teach finance classes as well.
Yeah, maybe.
Boom.
All right, so we can open it up to questions. We can go about 15 minutes or so of questions.
I'll jump in, guys. So you made the comment about kids. Yes, my 12-year-old bought a gaming PC, saved up all his money. It has the NVIDIA chip in it. I also agree with your price, which is why I sold it at 407, 408. Missed the last 100. But again, my 12-year-old still owns it, so there's something there. Valuation, we talk about growth. Let me just ask you this from a technology standpoint. It seems like every generation, things theoretically slow down. So the Intel Pentium 1 processor came out, then the Pentium 2, and then there was a little bit of a gap. And the next incremental phase didn't seem to be as good. And all of a sudden you entered this long-term, very slow cycle for an Intel. With NVIDIA, they seem to be out in front of it with these processors that are being used in all these different capacities. Is there a point where the next generation just isn't that much better and we see growth slowing? Or at this point, we're so in the infancy of these types of processors that A, the overall demand in the market is going up, and B, the replacement cycle is still happening at an accelerated pace? Where are we with this stuff?
So right now, NVIDIA was actually able to come out with one of their new processors. And I believe, if someone correct me if I'm wrong, they are selling it for quite a bit less, but it does twice as much. And so demand for that is at quite high right now. But the problem they're finding with that is that there's way too much demand for how much supply. And so that's a complaint that a lot of people are having with NVIDIA, is that they are not able to supply these as not nearly as much as they can. As for future growth, I think it's more likely going to be into the AI section.
Hey Kyle, I can take the future growth from you if you want me to.
Sure, you can take over.
Yeah. So I actually watched, it was like a YouTube video on how it's like the speed of the processors it is slowing down, and that's because of it's an energy problem. It's because the computers nowadays require so much energy to get this information relayed. The energy is too much for these chips to handle, and there is a certain point it'll start to stagnate. And they're actually starting to look at new alternatives to silicone even. I think if it's graphite or graphene, I can't remember what it is, but that's an alternative they're looking at. But yes, to answer your question, things will slow down, and there is limits on this technology, but that isn't to say that they aren't constantly pushing the envelope and looking for alternatives.
Tyler, can I jump in? I think that's a good question, right? So if there's a demand for technology getting faster, and part of the growth is through this replacement cycle for faster and faster technology. But the thing about these GPUs that's interesting is there's growth that's not associated with necessarily the additional speed in the replacement cycle. It's growth for a whole new use category, right? So AI, neural nets, and all this big data that we have can be pumped through the parallelization that you get in a GPU much better than a CPU. And so it's a completely new use category to some degree. Now, like, again, once you sort of get this massive adoption, then you sort of, again, can talk about your sort of failure to increase the speed at a fast rate and sort of declining growth because we can use old GPUs and that kicks in. But I think part of the growth currently is this sort of new category of use of these GPUs. Does that make sense to everybody or not?
Yeah, that makes sense to me.
Yeah. Casey's giving me the so-so. All right, I'm gonna go back to turning my camera off and just enjoying the conversation. Thanks, guys.
Well, that was kind of where I was going with that, TJ. So as far as your ability to answer the questions, I'll give you very high marks.
So my turn? Okay. So, all right. You mentioned Turtle Beach and NVIDIA. So my students in Milwaukee own NVIDIA. My father actually sold Turtle Beach after he, not quite doubled his money. So thanks to the students at La Crosse, I told them about it and bought some. There was a catalyst, the reason why Turtle Beach went up so much. And I'll tell you what its catalyst was, originally what the students presented and why the stock did this. And I want you to tell me then what's the catalyst for NVIDIA to go down. Normally when a company changes significant direction, something's driving that. So the original thought on buying Turtle Beach was, I think Microsoft was going to come out with a new gaming system. And when people come out with a new gaming system, now the group actually told us that you absolutely have to have new headphones. Post the meeting, they actually pointed out that is not true. They actually did some more research, but that would have actually driven up headphone demand this year. The stock was actually going down initially in coronavirus. But then all of a sudden some monthly numbers came out and said everybody's doing all kinds of gaming. And they just went to the upside. Everybody's sitting at home and they're playing in the stock market and they're playing video games. And probably the same people who are doing both. All right, a little bit of that. So that's what's happened to Turtle Beach this year. Maybe the catalyst is still going to happen, a new hotspot system, and then people upgrade their headsets with it. They don't have to. But anyway, the stock went up for a reason. It's now, you pointed out, trading at a pretty low PE. And NVIDIA is trading at a high one. What would be, but probably 5 times as high as my guess, what would be the catalyst to make NVIDIA come down? What's like the business thing that makes it go down?
So I'll take this one. I think that ideally, I believe the catalyst would be the vaccines coming out and working well. And then I don't think people enjoy sitting in their homes playing video games. It gets boring, it gets stale, it gets old. And realistically, it's just not a healthy way to live life. You want to go talk to people. And so as we talked about a lot, their DGPUs are a big source of their income. So when people stop buying those because they're not at home as much, I think that would, maybe it's their next earnings report, or maybe it's 3 earnings reports from now, but eventually they're going to see a decrease in sales. I think it was just an extremely explosive amount of sales that they saw from these last few quarters that shot the price up. And I think it's going to eventually stop because coronavirus will hopefully be fixed and cured.
Okay.
And then just to add on to what Griffin said, so a business catalyst would be, I guess, because technology moves so fast. So I guess, if Intel tomorrow were to come out with a GPU that is twice as fast as NVIDIA's, I think that would be a pretty big catalyst from a business perspective.
Absolutely. I'm actually looking at the earnings estimates or sales estimates. October was up 36% from the prior year. The prior quarter was 26, the prior quarter was 27, and January was down 12%. So this supports your thesis that once people, and it was up 13%, that was actually, that could be the whole year, the ending January 20, and the prior year was up 13. So yeah, you know, and then if I look at estimates going out forward, well, by October 21, they only have them going up 9%. And then, and then 2022 is only up 4% for the whole year. So the analysts think this is going to continue for several more quarters higher, but you just think it's going to, you know, once it slows down.
I personally think it's going to continue for, I think, a little bit more, but I think once, again, like we've said, once that pandemic situation gets figured out and everyone returns to their normal lives, I think it's going to go down near towards that target market, and then I genuinely think it's going to stay near there, which is why I think our recommendation of buying near that 400 price would probably be a little bit better, because I think if you just buy right now, at some point you're just going to lose.
Well, it's trading at a 50 PE on those numbers, which means it's 100% more than the market. Hey, by the way, why do you think Turtle Beach's PE is trading so low?
Personally, I think maybe it might be because of low growth. I don't think that they've made any extreme, I haven't looked too deep into it, I'll just start with that, but I don't think that they're making any extreme moves or any really interesting acquisitions that is going to change how their business is run. So right now, honestly, I don't see many more products besides gaming headsets. And when maybe you're looking at a competitor, let's say Corsair, who just started trading publicly, I think really recently, they have many more products. And if you become loyal to someone like Corsair, like the loyalty will spread maybe to the headset. Maybe you're trying more of their products. And I just don't think Turtle Beach has that. So while they might not lose in sales, they just don't have the growth, and their other forms of revenue aren't going to be that strong, I think. So yeah, to answer your question, PE is probably low because of low growth potential, I'd say.
Okay, I would agree, and actually analysts agree with you. They're supposed to make about $1.77 this year. In 2021, supposed to make $1.36, and sales are supposed to be down a little bit. You know, so this is, but it's the same type of thing for NVIDIA. It's just you're going from 30% growth to maybe 8% growth, and I would argue that something doesn't deserve a 50 PE if their growth is going to fall that much.
Other questions? We can.
Yeah, I will ask one more thing. Long term, when you've made some kind of comment in the presentation that maybe 25% growth for some time, but I didn't get a sense for what do you think NVIDIA can grow long term, let's say over the next 5 years? And by the way, let's go back to your valuation slide. Go back to that slide. You said you don't like the Gordon growth model, the free cash flow one. I think it was because, you know, you can only use a 3% terminal. There is a way around that. So could you go back to that slide?
Okay, yeah, so I can talk about that a little more.
Could you go to the slide?
I don't know if I'm the presenter.
Can you, because I have the PowerPoint up on my screen, are you able to see?
I'm able to see the last slide, NVIDIA proposal, but I don't see it moving. There we go. All right, there we go.
Are we there? Are we on valuation now? Okay.
Yeah, where you do $121. You don't have to. What is your solution? And by the way, go to this. What PE did you use?
Yes. Okay. So for that 121, I believe we used a PE of.
Well, you didn't use PE for that one. You said you used a 3% terminal.
Oh, right. Yes, for the 100. Okay. So we don't have the entire formula on this.
So what did you use for the PE for the one that's a higher valuation, and then you use 3% growth for the other one?
Yeah, I'm sorry, I might be confused here, but so for the PE on the free cash flow method, we did 77.44 times, I believe it was, times 8.15 to get this. Sorry, it's hard to visualize without having it pulled up. Can I pull it up? Do you mind?
Yeah, that's fine.
Okay.
So first of all, the free cash flow one, I think, was something you were just doing free cash flow divided by cost of capital minus the growth rate. And I want you to learn something that you could do to adjust that model.
So, okay. When we were talking to Casey, because Casey was our mentor, he mentioned that we should try to extend our years from just 5. And I will be completely honest. This model was presented to us by Adam, and it was just a time crunch, and I didn't have the time to completely contact Adam to learn how to,
all it is you forecast free cash flow for the next 5 years, and you take it divided by 1 plus the cost of capital to the appropriate year. So if your free cash flow in year 1's 1 and your cost of equity is 10%, you say, what is the value of that today? Well, 1 divided by 1.1 to the 1 power. If free cash flow in year 2 is 150, then it would be 150 divided by 1.1 squared. And you do that for 5 years until you actually have a point where the growth rate slows to a reasonable rate where you can apply, what you did here on a single stage. Let's say year 5, free cash flow is $5. And after year 5, you say their growth is slow. Well, then you can take the cost of capital, let's say 10%, and you subtract 8 from that, or 3% or whatever. I never use 3%. So many people in the profession do, but frankly, you would think you would. And that's the typical thing people do. I don't know why they always think a company goes away. You use GDP growth if it's going to grow the same pace as GDP, and GDP is real GDP plus inflation. But anyway, you would want to use a 2-stage. So good, you know the answer. But what PE did you use?
So for the free cash flow, right?
No, it's the PE method. You didn't use a PE on the free cash flow method, did you?
No. So for the PE method, you're talking about the optimistic, right?
All of them. What did you use?
We used the next year's PE. So the estimated next year's PE.
No, you use your PE. What you think it's going to be.
Right. No, that my estimate for the next.
Okay, good. All right. So
do
you know what that was? Do you know what that was?
No, was that a test?
No. Do you know what it is? What did you use?
Oh,
we have the numbers, but they're on an Excel sheet.
Yeah, that's the Excel sheet that I was trying to pull up earlier. I think. I'm pretty sure. Sorry. So, I believe we used the 8.77 times the current. That was EPS. So the current PE that we used was 77.44, and we multiplied that by next year's EPS of.
Well, you're saying 77.44 is too high a value. What should you have used? Because you're saying that's too high. So you should actually use what you think it's going to be, not the current one, right? So you're saying I'm paying too high. I'm paying 77 times earnings. You should actually be using what you think it's going to be, and when the market becomes more rational. And then multiply that by the earnings. Okay, that's all I wanted to do. I wanted to ask you that, and because I think you could have gotten a $400 target then.
On the PE?
Yeah, if you would have said, hey, I think it's worth 50 times. Well, 50 times 8 is 400, right?
Yeah. All right. I appreciate the advice.
Okay.
I will
right.
say in our what we were doing for our PE ratios down the line, what is it? Our 2022 PE ratio that we believed it would go down to was in the 50s. So maybe
Okay.
around 2022, it'll go down to that line.
Okay, all right. Okay, that's it for me.
And I think there's some confusion there, Kevin. They did do, project out 5 years, and then after that, a terminal 3%. And then I think what Casey's advice was, and Casey can jump in if he wants, that maybe that 3% is probably not realistic. That build it out more than 5 years.
Okay, I got it. All right, so you did do a two-stage model. That's awesome. Okay.
Yeah. And I don't think we said it, but to get our target price, we weighed the PE ratio as 60-40 to the free cash flow. I don't know if we said that though.
Yep. Okay. Hey, just a comment for Adam. I don't know if we're going to have this chance later. I really like it that you really emphasized to the students this year to try to quantify some of these drivers, how you guys were quantifying things, they figure out how GPO is 55% of the business and what was the possibility. And I saw that in a lot of presentations and you guys today, and I like that.
All right, so any final questions before we wrap things up?
I got a couple quick questions. First, I'm super happy that I didn't steer you guys wrong on that because I'd feel like an idiot.
You should still feel like an idiot, Casey.
Well, I do feel like an idiot because I focused more on the free cash flow than I did on the PE, so I apologize on that, guys, if I let you down. I guess, just a couple things, and this is more like constructive stuff, but I'll start with one question because it wasn't really brought up, and I was more curious, and I was going to ask you guys actually when I was talking to you, and I forgot, but I know Adam was in line on Black Friday trying to buy the PlayStation PS17 or the Xbox 21. Is NVIDIA in any of those machines at all? Because I would think that'd be a growth engine.
I genuinely do not know, but I could look.
No,
I don't believe so.
Okay, I was just curious because if you would have told me yes, then I guess I would have been interested to see how those, since those are supposed to be such huge hits, how that would have impacted their earnings. But if that's not the case, it's not a big deal. And then I guess from more of a learning perspective, because I didn't get a chance to see your slide deck. I know it's in the paper, but for those that are less technologically inclined, can you actually, what does GPU stand for? And the reason I'm asking is that finance is like the acronym king of the world, and everyone throws out acronyms and nobody knows what the hell they mean. So
should be graphics processing unit.
Okay, cool. So anytime you're giving presentations like later in life and you're using acronyms, make sure that you always use or kind of say what it is in the beginning, just so people know, because people like myself sometimes are shy and we don't stand up and actually ask that question.
Yeah.
So it's helpful. Secondly, and again, this is more from a learning aspect. Can you guys go to the slides like growth story, DGPT or GBU? Yeah, I can't say it. Slide 13, I think. Yeah, that one there. So I did something similar earlier in my career, and I look back and I kind of cringe. This is like a super, super busy slide with a lot of data, and it's kind of all over the place. And the way that it's organized, I want you guys to think about this again later in your career. Not having so much data jammed into one slide that it makes it very small for Tyler to read because he's got bad eyes. And then just the way that it's set up, like, there's a lot of different things that I can talk to you guys like later on about how to do this, but just as you go through life doing, PowerPoints after PowerPoints after PowerPoints, be very considerate to your audience as to how you show data and making it very easy to read and understand versus, again, making it very busy. So again, just kind of more constructive learning type advice.
Okay, thank you.
All right, thank you.
Would you recommend it's just kind of doing what we did, but for more of it, saying like see appendix for the graph, and if there are any questions, then we could just go to that.
Well, we don't have the presentations, so.
But I'm saying like if you see it in this type of platform, then you'd be able to say, because I know for like a paper, it's easy to just put in, an appendix with all the graphs and then say in appendix A, you have this.
Yeah.
Is that something we should do for a presentation later?
I mean, you can put some of that, like your supporting detail in an appendix. I mean, a lot of times if you were going to do this in a professional setting, let's say you're going to try to you're an analyst working for Merrill Lynch and you're going to pitch me on this stock, you might have an appendix with all the information in the back kind of as a support, but I'd have that deck physically. Since, Kevin mentioned we don't have this deck, we can't access it. So I think, showing the data is fine, but you have to, there's a balancing act in life of having, number one, the right data, and then how much you fit onto one screen so you can actually read it. Like the stuff at the bottom, revenue numbers and the 6 zeros, that could be cleaned up a little bit. So it's just, like I said, it's more of a learning opportunity for you guys to think about, moving forward. Maybe also when you're looking at, and I think you guys went and listened to or saw your peers' presentations, from a quote unquote best practices, which is another silly term, but just seeing how other people do it and kind of getting an idea as to what you like to see is helpful.
Sounds good. Thank you.
All right, well, we're running a bit over, so we should probably wrap things up here, but good job on the presentation, guys, and thanks to everyone who joined